Welcome, everybody. This is the last panel, and we're going to stick to the concluding time because I understand the bar is opening, and that apparently is a heavy draw. Anyway, I'm Richard Grant. Welcome, everyone. I'm a partner with McGuireWoods. I am in the McGuireWoods Los Angeles office. I'm on our private equity team. I do mostly sponsor side, buy side transactions, and do a lot of work in the independent sponsor space. So glad to be leading this panel. This panel is, we have 5 capital providers with, and although 5 capital providers, all with very different perspectives. And so I think you'll find it interesting to hear from them about what they're looking for and what excites them in deals. And I think it'll be an interesting panel. I want to kick off with have each of the panelists, rather than me giving the introduction, I want them to introduce themselves, tell you about themselves, about their fund, and give you the general overview of what kind of investments they look for, deal metrics, those kinds of things, for 2 reasons. One, just so you know the context of what their thought process is when they're answering questions. But more important than that, this panel really isn't to talk about what they look for in deal metrics and all that stuff. You can talk to them about that and go on the website, and probably for those of you who know them already know all that information. But we want to talk about more of the practical aspects of what each of them looks for and in a deal, and some of the unique characteristics and unique thought processes that they have when they're out looking at deals and working with independent sponsors after they've funded the deal. So why don't should we just go down the row and I'll let everyone introduce themselves. Okay. You're first.
I'm Ron Baker, group manager for the Dallas office of Cadence Bank. Cadence Bank's a Houston-based company. By the end of the month, we'll have about $50 billion in assets. Our footprint runs pretty much from Texas all the way to Georgia and all the southeast states and all the major cities in between. We pride ourselves on doing a lot of sponsor business. We do it nationally as well as locally in regions. Our focus is deals pretty much on the low side of EBITDA of 5. Up to say 35 million. Our home position on the senior credit, we're just a senior lender. On the senior position, our hold limits around 20 to 25, 30 million, although we'll do much larger deals with bank partners. We pride ourselves by, I mentioned the sponsor relationships. We have about 50 relationships with SBICs, mezzanine lenders as well. We actually invested in them. So they have some intricacies there. We can provide senior as well as mezz through introductions. And that's really, I think, what makes Cadence Bank different. We pride ourselves on introducing sponsors and or independent sponsors to various capital providers besides ourselves. And so we look at it as a full relationship. We're cash flow focused. We do have an asset-based lending group, but the group we manage, majority of our assets are cash flow based structures.
Good, Jeff. Yeah, good afternoon. I'm Jeff Ennis, Ocean Avenue Capital Partners. So we manage institutional funds and partner on a deal-by-deal basis with sponsors, almost exclusively independent sponsors. We do 10 to 12 deals a year, so pretty high volume. We've done over 120 transactions in the past 10 years since we founded the firm. We're looking to invest $12 to $15 million per deal. We'll flex up or down a little bit. We're happy to be the sole third-party equity provider. We're happy to be part of a syndicate. Be very flexible. We're generalists. We don't do real estate or oil and gas exploration, those sorts of things. But other than that, we're just looking for unique deal dynamics. We only focus on the lower middle market, small deal markets. Everything's mostly under 100 million in enterprise value. We're looking for a certain return convexity that we think is achievable in this market. So we don't underwrite to a higher upside, but we want to see a path to some upside optionality in everything that we see. I would say we're like a moderate touch governance. structure. We want board observation rights, board information rights, but we're really looking for our partner to sponsor the deal and build the value. So that's a big part of what we'll talk more about here as to what we look for in those partners and how they match up to the.
Thanks, Richard. My name is Vladimir Andonov. I'm a Director of Business Development with Martis Capital. We are a lower middle market healthcare private equity firm with offices in San Francisco and DC. Within healthcare, we focus in healthcare services and outsourced care delivery. Then we also spend time in healthcare technology. And finally, in consumer and products. In contrast to my panelists here, we actually do very few deals a year. So it'd be nice to compare notes on that. We do probably 2 platform deals a year, so we're very picky, which is a good thing. I think we all have to be, and which means we select partners carefully and build relationships for the long term. And just on the metrics point, on an EBITDA basis, companies between 3 and 20 of EBITDA. When we're looking at more technology-oriented businesses, sort of SaaS software, it's more of an ARR focus, so 5 to 10 of revenue. And from a check size perspective, I'd say anything between 15 to 75 is within our sort of ability to do. And we've done a few transactions in the past with independent sponsors, with other funds. We'll probably talk about it today, but in the end, a good deal is a good deal. So I think financing is hopefully one thing you can just solve for. Right? Glad to be here.
Thanks.
All right, thank you. I'm next, Jay Fuquay. I'm at Trinity Private Equity Group. We're based here in DFW, basically, right? Southlake, Texas, up by the airport. We have a good team at Trinity. It's 30 or 40 folks. We're potentially different from some of the other groups in that we basically are an independent sponsor, or certainly that's in our DNA. We've developed a model where we're now backing sponsorship groups with a majority equity capital, typically for good deals, just like everyone else has mentioned here. For some pace, we're going to invest roughly $400 million of equity this year across 25 or so offerings. We're looking for good deals. Our check size is probably something in the 6 to 8 range, all the way up to call it 30 or 40 for the right opportunity with the right sponsor. Echoing something that's already been said, we rely on the sponsor, right? The sponsor is truly our partner. In our background is entrepreneurial and partnership oriented approach to deal making. And so each one of our investments is a true partnership between ourselves, a capital partner, and the sponsor who's leading the deal.
John Kim, I'm a co-founder of New State Capital Partners. We are a private equity firm based in the suburbs of New York with an office also in Southern California. So we started about 8 years ago. 3 of us, we started out as an independent sponsor. Fast forward to today, we are investing out of our 3rd fund, which is $450 million. Like Jay, we've come full circle and have backed independent sponsors as well. So we are focused on the industrials, business services, consumer services sector, companies that are generating 8 to 40 million of EBITDA. And so I think kind of how we try and differentiate ourselves, we're a sub $500 million fund, and how we try and differentiate ourselves, amongst the other thousands of other funds out there is we try and be a true value-added partner. And I know everyone says that, but we've got 18 people now, a third of whom are on our portfolio operations team. And so these are people with functional expertise. They've been CEOs of private equity owned businesses, CFOs of private equity owned businesses. We've got an internal recruiter to help, either find new management, augment management. They can go all the way from mid-level all the way up to the CEO. And we have someone who's focused on performance improvement. So think kind of Lean, Six Sigma, Black Belt, that kind of expertise. Appreciate being here. I do want to give a plug to Jeff Ennis at Ocean Avenue. He was a huge reason for our success so far.
Thanks, John. Thanks, gentlemen. And I should have mentioned at the outset, we'll leave some time at the end, a few minutes at the end to ask questions. But if there are questions that pop up while we're having the conversation, please raise your hand and we'll call on you. invite questions and want to make sure that you have an opportunity to engage with our panelists. So why don't we kick it off with Jeff? I'm going to put the first question to you. You guys have been doing this as long, probably longer than anybody else. You go way back with your fund, saw the opportunity in the independent sponsor market long before most of us did. And I know that first and foremost for you, and I think it's always been your thesis that you need to have a good deal first and foremost. You're looking at the deal has to meet the metrics that you talked about in terms of return and what it can do for your fund. But once you're, and then you also talked about partnership with the independent sponsor, and I want to focus on that latter point, which is partnership with the independent sponsor. So you're looking at a deal, it meets your investment criteria generally, and then so now you're talking with the sponsor. What are those initial characteristics that you're looking for? Again, you've looked at a lot of deals, and what are the things that are jumping out at you, good or bad, from doing this for 10, 12 years?
Yeah, so it is deal first. So I would say the deal is number one and the sponsor is 1A is maybe the way to think about it. And they play off each other. So I described what we're looking for in the deal. So it basically want that certain return convexity, certain amount we want to invest. And we're thinking about the execution risk. And we're kind of balancing all that. You know, we obviously need to take some execution risk to generate the returns we're interested in, but we don't want to take too much. So, and that's a judgment call that we're making. And then the first question is this a backable sponsor? And we're thinking about track record, experience, those sorts of things. And then maybe the second one is this the right sponsor for this opportunity? So if you've done 10 deals all in aerospace defense and you bring us a CPG deal, we're probably not going to get there on it. So that's just a more of an extreme example, but that's how we're thinking about it. So that's where kind of our judgment comes in is we see a lot of flow. So we see over 400 deals a year at the LOI stage. And we're going to do 10 or 12, so it's less than 2% of what we see. So we're set up to try to be very decisive. We know what we're looking for. I will say, I've talked to a number of you the past day or so. It is helpful to see what you're working on over time, even if it may not match up with us at that time, just because we get to know how you think, what type of deal. So when we finally find something we might match up on, we're not starting from time zero to figure out who you are and we've got a feel for it already. So, I mean, that's basically, we don't have any black line rules. I think the number one rule at Ocean Avenue is we're opportunistic. Having said that, if you look at the people we back, they tend to have more traditional private equity backgrounds. They've been at funded firms, some of them at well-known firms, but not everybody. So it's really contextual to the deal and the sponsor. And we try to be as transparent as possible. So we'll just tell you, hey, we don't think we're going to get there for whatever reason. And our goal is that you'll think of us next time. And at some point in the future, we'll find something to do together.
Jay, I'm going to pass it down to you. What are your thoughts about that relationship with the sponsor? I thought that was interesting, Jeff, that I think sponsors oftentimes forget that the deal may not be right for the particular capital provider. Nevertheless, build that relationship because at some point there's going to be the right deal. And if you have that relationship, you've got a better opportunity. What are your thoughts about that?
Yeah, no, that's absolutely right. He said, 1A and 1B, I make a weird analogy, but we're betting on jockeys and horses, right? And with the deal of, I guess, being the horse or the sponsor being the jockey, it starts with the sponsor, right? As I mentioned, we're looking for the sponsor to take the lead, to be convicted, to be excited and passionate about their deal, have a value creation plan that they're excited to execute and an ability to show that they're capable of executing it, right? And so that is really kind of fundamental. We'll invest in all kinds of deals across all kinds of industries, but we're really needing that subject matter expert who is going to come and tell us why it's a compelling risk-adjusted return and something they're excited about spending the next 3 to 5 years on, and working really hard to create that value. We like all the usual suspects inside of a deal with margin profile and sales and things, so I won't bog down in that. But what's important is communication that's consistent and robust over time, right? And absolutely, reach out. And when you show me a deal, if we haven't interacted a lot before, show me a deal and show me like a corporate presentation that says, here's who we are, right? And then if we pass on that first deal for one reason or another, we're just that much further along when it comes time to the next one, right? And we can go faster, and there's already a relationship that's in place. So I would say that's kind of our mindset with respect to, identifying deals at the front end and nurturing a relationship. We are entrepreneurial, right? That's in Trinity's DNA. Our founders were entrepreneurs, so we like to back entrepreneurs or kind of emerging sponsors. Not every single person has to have, worked at $1 billion fund previously or have a track record with, 18 exits on it. Those things are nice and they help, but if it's the right person with the right deal, we can absolutely, take a look and get excited about something.
And what about things that you may see in the early stages when you're considering a deal? Maybe it's a deal that meets your requirements and it looks good. Are there things that I don't want to be negative, but I think it's helpful to share stories, but things that you see that about the independent sponsor in particular, that may make you think that perhaps it's not a good fit for you guys? Ron,
We'll start.
I'll let you take that one.
Our success has been, we've closed about 35 deals in the last 3 years, about $500 million in capital. And we were just told, we just won a deal the other day, a $60 million transaction. And we were told that transparency and trust were the reasons that we won the business. Because we were open and honest from day one. We told him, the gentleman, what we could do and how we could do it. And we did that. So to that extent, we want the independent sponsor to be totally open with us. If he understands the industry, understands the business, or if he doesn't. Financial modeling is important to us. We want to make sure that he and the management team, understand, where the future is going to be in the next 2 or 3 years, not so much the past. And so when we present that internally for our investment group to make the decision, we want to make sure we know exactly what they expect of us in the future and for the transaction is going to close right now. And just that trust goes both ways. And so when we get a mixed story on what the deal is versus what it's going to be, that's not good. So we just want open honesty from the very beginning and as much information as possible. Bankers are known for asking 45 million questions, but we try to be very efficient. And I think that's very helpful to have an independent sponsor who really knows the business and also the management team he's been working with. That's obviously very, very important as well.
And you have to hear about the bad aspects of the deal, because there's if it's a perfect deal, then there's a problem.
True. And when I go to our investment committee for the decision, there's going to be a question or two. And if we don't have the answer or haven't uncovered that question, he needs to know, they need to know what the answer is.
Yeah,
for sure.
If you can't tell your investment committee what the downside is, what the problems are, what problems you can solve, it's a problem for everybody.
And that's a great point, because not every deal works out exactly like we predicted it to do. So if we can work with the management team, with the sponsor to get to the next level of fixing that problem, communication is key. And so the bottom line is communication and trust, as I said earlier, are ultimate in being successful, even in your bumpy days.
Vladimir, John, what do you guys want to add to that?
I was going to add, maybe just as a direct jumping off point, the communication piece. One example just very recent was we were working with an independent sponsor on an opportunity, and they had sourced it, got to an LOI, and brought it to us. And we had a few calls, diligence calls with management, where the independent sponsor would jump in, basically, even though the question was phrased to management, he would jump in. And what impression it left with us was a little bit of being protective. It's like, I'm the one that's going to be the gatekeeper here. And I think it's more, everything I'm hearing here is really, and I think that section is that of partnership, right? And I think it sort of sets you off a little bit with the wrong feeling of, is this individual, this group open to a partnership with us? Are they feeling, I don't want to use it in a strong sense, but insecure because they have the deal and that's sort of their leverage point. But so that was one example we had. It got much better when we were very direct and open. To Ron's point, right, communication and trust, establishing that. Another thing we've encountered was that I would say more of like a yellow flag would be understanding, obviously, the independent sponsors have to front a lot of the due diligence fees. That's very important. How, if it's a broken deal, what happens there, or even the economics of the transaction. But there's also a balance of how much they're really focused on getting that buttoned up first versus maybe talking about a transaction. It sort of tells you, and it's a fine balance. I totally understand it. So it's one thing to have a committed fund. You kind of, the lights keep on, right? But so that's one thing where I'd say as a point of maybe feedback would be just make sure you communicate, you examine about a transaction and kind of leading that. And hopefully the conversation around economics and some of those things will be worked in parallel versus let's solve that first. And then one last point just from experience was, we'll probably talk about it. What's the best time to probably bring in a capital partner, which I'm really curious to hear fellow panelists' thoughts, but there's an advantage to bring a deal that's an LOI phase because you're sort of further along, it's actionable. But at the same time, if there's some terms in the LOI that are, man, we wish we were around the table when that was negotiated because now it's tough to really undo it. So that's something if I was preparing for the conversation today, I noticed like an aggressive LOI. If there are terms in there that you feel like, man, this group was really aggressive with their bid or something, that's maybe a bit of a yellow flag. And I think COVID only exacerbated that because you wouldn't really know. We probably have as healthcare investors very strong views perhaps about some areas. And if a group brings us an opportunity that maybe it's a bit of outside their comfort zone, there might be a bigger delta on what we feel is like an underwritable EBITDA versus what they thought. I think COVID just widened that spread even more. So anyway, I threw a few things here, but it probably just still comes down to the same point around communication and transparency at the end of the day.
Yeah, an interesting point is about thinking about the due diligence costs and how that all shakes out. And one of the challenging things from the sponsor side is we're in just such an intense market that there's an enormous pressure, time pressure. So it's just balancing all those things, and because of the market environment we're in. John, did you want to add?
Yeah, I guess, I think back to when we first started out and the 3 deals that we did as an independent sponsor. And it kind of, it'll, I guess, touch a little bit in terms of when to bring a deal. Everyone kind of feels differently. But when we got a deal, we would get a deal under LOI. We'd do everything we could ourselves to get it under LOI. And when we presented to capital partners, and I think Jeff can probably corroborate this, but we came with a pretty full deck. I mean, it was a 30 to 50 page presentation that outlined everything from how we got it under LOI, why us as the independent sponsor, what is our angle, and I think that's very important. What do we think that we can do? And then obviously there's a description on the company, and we've put our there's like an appendix with the model and we've thought about all those things. So we try to do as much diligence as possible without, and then leaving kind of the bigger ticket items like legal, a consulting report, the third party accounting report. But I mean, it was we tried very hard to put together a very buttoned up deck. And when capital providers were asking us questions, you're doing enough and you can anticipate, what the questions are, but you really kind of had to, we had to be on point in terms of what the answers were. And if we didn't know them, that was fine. But again, that goes to communication, just being completely transparent. And we even put a section together in terms of, our last page, how much we thought kind of we would spend on a, for the capital provider, how much we would spend, on third-party diligence reports and things. So I say all that, and that's how we operated in terms of, going to capital providers and having the deal under LOI and having a full, investment deck. But, with certain independent sponsors that we've gotten to know quite well over the past couple of years, they'll just check with us and say, hey, just make sure this isn't in your CRM or you guys aren't looking at this. And if it's not, then they say, hey, would you mind kind of attending a management meeting with us or looking at this, at the same time so that, like Vlad said, if you get it under LOI, you don't have to undo certain terms that maybe the capital provider, won't agree to. So it's a fine balance. I mean, I think, we're generally as a firm pretty flexible in terms of, when, we see a deal, but others may have a different, perspective.
And I want to look back to that, Vlad, you started to touch on this just about the process when the deal is underway. You've signed a LOI with the independent sponsor. What do you expect the process to look like from nuts and bolts early on in the deal and getting it to close? What are some of the expectations and things that have worked and haven't worked? Jeff, you want to start?
So the kind of the steps early on as far as what we want to see, or
just getting the deal to close. What are some of the key expectations and interactions that you want to have with the sponsor, and that you feel the sponsor should be doing to properly manage the deal and managing the relationship with you guys as well?
Okay. So we have a one-team approach. So our whole firm works on every deal. There'll be a deal lead that does most of the interaction, but all the partners are going to meet the sponsor, meet the management team. Most of that's been happening over Zoom. Just go back to in person. We won't fly everybody, but so I guess where I would start, maybe to touch on one of the earlier points, is it's really helpful. We're a pretty high volume shop. If you have something to have a really clear executive summary. So if you have a deck that John talked about, that's great. If you don't, just, how did you source the deal? What's your angle? Why is it priced the way it is? Why are you excited about it? Where are you going to add value? And kind of what do you expect? And what's the upside if things really go well? So kind of the elevator pitch, just like, and what's giving you the conviction? Because if you're not convicted about it, or doesn't come across if you're convicted about it, we're not going to do it. Because we want, something, we hear stuff like, hey, this is the best deal I've seen in my career. We pay attention. Well, why is that? So it really starts there. And then, then if it's something that we've initially vetted, so everything goes in front of the whole partnership, and then we'll have the whole firm, hear the story firsthand. We're committed to have you always dealing with the decision makers. We founded the firm, we own the firm, we're the investment committee. So there's none of this filtered information at any point in the process. Let me check with the committee on that and get back. You're always talking to the committee. We're going to do our own third-party verification, primarily with a firm like GLG. We'll work our own network. We're happy to invite our sponsor partners onto some of those third-party diligence calls. We just want third-party confirmation to everything you're doing. We're going to do our own verification of modeling, doing a lot of sensitivity. We're going to do that in conjunction with the partner. So we'll usually ask for their model. Our analysts and associates will work it up, and then we'll have a model call and go through and say, ask a lot of detailed questions about scenarios, impact on margin. We're really thinking about risk, and we're in that process. We're really seeing how well the sponsor understands and has thought through these issues. And then at some point around there, we get to the point where, like, hey, we have enough conviction. If the rest of the diligence checks out, we're good for the money. And so we've never had to walk away from anything, past that, unless we agree with our sponsor partner there's adverse diligence findings, and we both didn't want to do the deal. And then, we basically, the remaining things tend to be primarily customer calls, legal. We may both be waiting on some events related in the company, or maybe there's a simultaneous add-on. There's some other things that we're waiting to see if they happen or not. And then we fund and close. So that's basically the process. We're very involved in the underwriting. and then we're observers on the board post-close. And so in that process, we're also evaluating, do we think this partner can execute and unlock this value on at least just see the interaction with the management team? We're not the sponsor. We don't want to be the sponsor. So we're not trying to compete for attention with management. We're actually happy if we do on-sites to go on with the lender groups. You know, we're there for information and to be helpful. Having said all that, you know, we've got a large portfolio. We see a large number of deals just through pattern recognition. We've gotten pretty smart on a lot of things. So we want to feed all that back in where we have relationships, introductions. You know, we're going to do that throughout the process during diligence and post-acquisition.
Yeah, and that's interesting, the observing the interaction, because that's going to be critical for you guys. You're depending on the team, and if there's something you see that you like, great. And if there's something you see that may give you pause, not so great. But
yeah, and we're just pushing. We're asking a lot of, you know, like I said, we've done so many deals and seen so much in so many industries. We can get to that second level, more granular understanding pretty quickly. And so usually with us, we're asking those level of questions, sometimes on the first call, if not maybe the second call. And, you know, if basically if we think we know more about the industry and what's going on than the sponsor, we're probably not going to do it. So I guess it is a little, to today's point, you know, we want to see it around LOI, but if you're still running a few things down and whatnot, you know, you just have to use your judgment as to when you want to expose it to capital partners that, you know, that you've got enough of a handle on it. And it just need more time, may need more time to do that. So in some cases you may not want to show it too early.
Jay, what about you guys? What are you looking for during?
Yeah, just to scatter sheet on a few things that have been said. There's kind of two schools of thought, one of which is more effective, right? If someone comes to me and says, I'm convicted, I'm doing this deal, do you want to be the equity partner? And I'm doing it because of X, Y, and Z. It's far more effective than, what do you think about this deal? You know, like what do you think I should bid, right? That's not the approach to take. You need to have a much finer approach than that. And so probably be kind of on the precipice of signing an LOI and just really communicate that enthusiasm and that passion for the deal. Also, in terms of presenting to a capital partner, this is the way I would suggest it, approaching it. To make our job easy, right? When you're telling us about a deal, we're going to have to turn around and be accountable to somebody, right? An investment committee or the leadership team or the firm. And if you have a fully baked package that makes that simple, that's going to go a long way, right? I mean, just think about operationally, if I'm having to present deals to our committee and someone gives me a fully baked cake to bring in and present, that's the odds of that working are much higher, right? So fully baked model, right? Fully baked corporate presentation on your capabilities, fully baked investment memo is better. And we understand that not every single point has been nailed down, right? Because this is the deal business, but the more full approach that you can present is just better. It's going to increase your odds of success. In terms of like kind of post LOI between us and the sponsor moving towards the close, I'm looking for the sponsor to quarterback the diligence process, right? We're going to watch and observe and understand everything that occurs, but we're not going to do redundant work, right? We're not going to repeat things and waste dollars. But I'm also looking for the independent sponsor to competently execute the diligence work streams and push the whole thing towards a close, right? That's definitely part of their job. And as that's unfolding, we're observing their interaction with management and with the work stream providers and the seller, and they're got a lot of balls in the air, right? But that's what makes a talented and capable sponsor who's likely to close the deal and likely to be worthy of backing over and over again. Really, when you're going through it the first time, one of the key mandates is I'm evaluating this group for subsequent deals, right? I'm kind of already committed to this first one, but as soon as that is the case, the goal is to understand if they're worth backing again, right? And you feel good about that by watching them execute.
Yeah, and Jay, such an important point about what does it mean to be fully baked? You want them to, you want the sponsor to ask questions, but they can't be the questions that indicate that they haven't thought through the deal. If they're asking you to think through the deal for them.
Yeah, a part of an investment memo is going to say key diligence points, and we're going to have to understand these four things better as we move towards a close. They're not going to know 100% about every deal, right? But if you ask some basic questions and they haven't thought those through, or it didn't seem to be something that was a focus, I guess that's a red flag. But no deal is completely buttoned up and perfect, like we mentioned. Everything's got some hair on it. It's just an ability to spotlight it and think through a potential mitigant. Right?
I was going to add something. I mean, it's picking up on Jeff and Jay that it assumes really that the sponsor is a domain expert or really knows a lot about the deal that they're going after, which is all good and well. And I think another version of that scenario would be probably what might be more akin to what Martis would be spending time at, which is finding a complementary sponsor for us to partner with. I could think of a situation about a year ago where a technology-focused independent sponsor reached out to us with a urgent care transaction that the way that they sourced it was through a relationship with the RCM company that was actually used by that urgent care. So they understood the business from that side, so the back end, the billing, the coding, the collection, but they needed somebody to help them with the, if you will, like the heavy lifting on the healthcare side. And I find these very sort of symbiotic partnerships where we'd love to be underwriting the deal somewhat simultaneously with that group because we could really complement each other's strengths, right? We can help them with the healthcare expertise, they can do the technology. So baking the cake sometimes together is not a bad thing, which I think this is probably the theme of these 2 days. There's so many degrees of freedom or options to explore that when we conclude the panel, I think one of my concluding remarks was going to be just I think there's always opportunities to partner. It's just finding the right fit, right?
And Ron and John, I'm going to turn it a little, let you guys talk about things in hindsight. You've done a deal that you look back and maybe things got a little off track at some point post deal, and lessons that you've learned, things you would have done differently. How do you get a deal back on track? Kind of take it from the other side or the different perspective, Ron.
I can tell you about a couple of nightmares, but I won't do that. We'll talk about one that we closed a refinancing about 4 years ago. Something called COVID hit. 50% of their business was dependent on retail. Good thing is they're really a working capital forward business, so there's a lot of cash, a lot of current assets. So the bank was in a decently levered position. We typically do deals that are 3x EBITDA in senior and less. So this deal was a little bit less than that. So it gave us some room to work with them. We asked them to put a little more money in. They said prefer not to, just wait a few months. So that's about where we are now, 6 months into it. The company's recovered. Or is recovering in. We don't have the financial results yet, but the backlog has just exploded. So they come out now. Thank you for the PPP government money. We were able to give them a couple of loans, so that helps as well. PPP loans, so that helped. But good people, people we've known forever. Actually, the Mez Group, we invested in their fund, so it's kind of family and friends deal. But the key there was the management team, the independent sponsor. The whole team was together and knew where we were going to go. And I get back to that transparency and trust and communication. In this case, it's just a great story. We're not totally out of the woods yet. We're getting there. But bottom line, our bank was able to help them. They busted covenants, went beyond where we wanted them to be, but we knew the cooperation was there and they were doing the right things. And that was a great story. Back to the other story, we had one that talked about our timing and knowing what the deal is. So we had a $50-odd million transaction. We funded half of it. I guess about 2-3 years ago. It doesn't matter. But long story short, we got in there with the group. They brought it to us on day one. We closed it in 30 days. $50 million deal. We funded half the transaction. We did all the QV, got their SIM, their model, everything was perfectly communicated up front. We closed the deal. The EBITDA has now gone from 6 or 7 to 25 million, almost 30 million in this short period of time. We've done 4 or 5 acquisitions, and now they're going to do a dividend recap. So that's a really good story. It's nice to see those other deals turn to that over time, but again, gets back to communication and transparency and just being upfront where we are.
John, I'm going to let you close. We're getting to the end, but so
Sure.
It's all on you.
So no, look, I don't think we've done a couple deals, and so I don't know if we've had any regrets. I would say, the first deal where we backed an independent sponsor, it's this recurring theme of communication and transparency. The group, they had a very good relationship with management, and so we were trying to kind of get in and try and meet management, and they were, the independent sponsor was the seller wanted to do the deal because of them, and that's great. I think the deal probably took a little bit longer than it needed to, in terms of the independent sponsor being able to manage the seller and the information flow that kind of we needed. And then there was like, well, these guys aren't moving fast enough. Well, we told you we needed XYZ and they haven't provided it. So, it wasn't anything major, but, I think, but again, it's just that communication up front saying, look, these are the things that we need. And we're pretty clear about that. And so that was a lesson learned from us. And, we're closing another deal with an independent sponsor. It's, quite large at 50 million of EBITDA. And so this one, really kind of wanted to move quickly. And so, I think this one was a great outcome. We'll close in a couple of weeks, but it's, that one was much more efficient. So we took that and we said, listen, you guys, we understand you guys have the relationship with the seller. Let's just get on the same page from day one and make sure that, the information flow is on time and proper. So there are no kind of finger pointing issues when it comes time to close. And so everything's been great so far. These guys probably have a little bit more of a bigger sample population, but that's kind of, the worst, if anything, that I would say is in my experience.
Thank you. I know I promised we would leave time at the end for questions and I didn't. So, but what I'll do is I'd like to conclude because I want to keep us on track. I know people have flights to catch. So a couple things. One is please join us for a cocktail reception, but also I know some of you guys have to run, but some of you'll be here. Come on up and ask questions and please engage with panelists. And I thank you for coming to this panel. Thank you for coming to the conference. Thank you guys.